Hey guys, welcome. It is 1 p.m. on Monday, December 18th, and we just got the closing bell. Uh, I didn't get a chance to really closely watch the markets, but from the little that I saw, it was just mildly directional. So let's take a more careful look and see how we develop throughout the day. So yeah, we did not get that pull back towards the previous close. So today we fell in that 30% chance of it not doing that. So today was just directional, very mildly, like steadily upward directional. We got flat during the afternoon. And then in the last minutes of the session, we started to trade downwards. That's not great news. Normally, we see a directional move up, or at least in the last month or so, we've been seeing that directional surge upwards towards the end of the day. And to get that downward surge today is not the best news for the S&P, but we are higher. And if we look at our daily chart, it looks like we kind of bounced back up to this purple resistance line that we drew in earlier. So we curved down and we curved back up. So what this now is starting to look like is just chop back and forth. So it's becoming more and more likely that we are just going to chop back and forth throughout the next week, or actually 2 weeks, because the amount of participants just isn't really going to be there. So what we talked about in terms of being able to take advantage of this was strong stocks that are strong relative to the market in strong sectors, and weak stocks that are weak to, and pairing those up. So the other one was gaps. So you can see how the market actually, we closed right here and then we gapped down to this open. And then we closed right here and we gapped up to this open. And then we had a little bit more direction. But the point is, if we traded late in the afternoon and then exit early in the morning, you can catch these gaps. And we're probably going to see quite a few of these gaps come in the coming 2 weeks because of how thin the markets are going to be. So another example of that is FTI. FTI was a position that I was in an example portfolio. I did a $2,500 challenge for myself, and FTI I exited on Friday at the open because I didn't want to take risk over the weekend. But if I had stayed, my viewpoint for that was the end of this week. And if I had stayed in it, you could see that we had this on Friday, it continued to move upwards and then it gapped up to the open right here, to this blue line. And then it traded down to this, to where it is right now, which is still a gap from where we had opened. But where we closed the previous day. But if we had traded the end of the day, so near the close right here, and then exited near the open, you can see that there is quite a bit of a gap right there. So that would have been a good trade for these gapping strategies. Of course, this requires you to be at your desk and trading in the last 1 hour to half hour of the trading day, and then again in the first half hour to 1 hour of the following trading morning. So if that's within your ability, then that could be a good strategy. Let's take a look at what happened in QQQ. QQQ is just a nice steady movement upwards, heading towards this sea green resistance right here, which I believe is the all-time high. Yeah, that's the all-time high. So we are approaching the all-time high. We did back away a little bit from it today. So we'll see what happens. But again, most likely these next couple of weeks, we're just going to be chopping back and forth. So this could be another situation where we go up, consolidate, up, and consolidate. And it just defies most people's expectations, defies most patterns of where we actually pull back from these 3 ATR Keltner channels. Although we didn't deviate, it just could take a little while, just like it did over here, for us to come back down and have that pullback. If we look at IWM, small cap stocks, big movements. Oh, sorry, it's hidden by this. We're just sideways trading. So gapped up and just sideways trading. So we really do need to break above this pink line right here in order to be comfortable that small cap stocks are indeed moving higher. And then we can start focusing on them because we will expect them to lead the overall markets, or at least the large cap stocks. We'll look at ARK. ARK pulled back a little bit, down 0.07, really flat, but the low made a new low. So that gives it that downward bias, that downward curvature. And if we look at our Keltner channels, then that's what we're looking for. We hit the +3 ATR, we pull back to that +2 ATR right now, and then we will expect this to hit at least the +1 ATR before it can resume upwards. And then the Dow Jones. Dow Jones is still, so we made an all-time high right here 2 days ago or 2 sessions ago, and we are still very close to it. So everything is really looking like it's consolidating and chopping sideways. The Dow Jones is well above its +3 Keltner channel, so I wouldn't be surprised if the Dow pulls back rather than, because it would take probably all week of chopping sideways for this Keltner channel 3 to catch up with it. So that's kind of a long time period to be so far above the Keltner channel. So it's a little bit more likely that we will start to see downward movement in the Dow Jones. So we'll just see if we pull back. And of course, our hedge that we talked about last week of the high reward risk ratio hedge was actually in the Dow Jones pulling back, although we calculated it all the way, pulling back all the way to the MA50, or the assumed position where the MA50 would be. But even if it was just the EMA20, that's still a pretty good pullback. If the market is super, super strong, then we would just expect it to pull back to the EMA20. If it's not, or if it's even stronger than that, then it could just only go back to the EMA8, which is where the C green line is as well. But if we did that, we would still be right on top of the Keltner channel, +3 Keltner channel. So we're probably looking for a deeper pullback than that. So today, there's not going to be, because of just the choppy sideways nature of the market, if that's what we got today, then it's likely that we're going to continue to see that throughout the week, unless there's something to really stimulate the markets. So let's take a quick look, because we didn't this morning, at the economic calendar. Housing starts, so this will affect real estate, or might be a reflection on interest rates. Consumer confidence will be important, and existing home sales will reflect the same thing as the housing permits. So if these are good, and then we get a associated increase in bond prices or a lowering of yields, then that could stimulate the real estate sectors, and then give us a little bit of a boost in the S&P 500. Consumer confidence will be a lot more important. And looking at that, GDP will be a lot more important. And then I think we have personal income and outlays. So on Friday, we've got this core PCE number. That's the one that the Fed likes to look at. So if we get the 3.4 consensus or lower, then that will probably continue the kind of crazy enthusiasm we've got in the bond markets, which means that our equities indices could go higher. But if we get anything higher, if we go above 3.5, for example, if we go up instead of going flat or down, then that could cause investors or institutional investors to question whether or not that rate hike that everyone's pricing in March is actually going to happen. So you'll probably see a pullback associated with that. I don't know about a huge pullback, but if it was just like even or 3.6, but you'll get a pullback almost for certain. And then the further we are above 3.5, if it comes in above 3.5, the steeper that pullback is going to be. So we do have some pretty significant economic stuff happening this week. So it could actually cause quite a bit of volatility and price movement because of how thin the markets are. Let's just see it for volume. Yeah, see today, you see how low we went in volume after the last couple of days. So our volume's super low this week. We're probably going to be down somewhat in this level throughout the week, and then probably an even lower level next week. So these economic type of news, if there's any shocks, could cause our indices to gap and to do some pretty wild stuff because we don't have the same amount of participation that we normally do. Another reasonably good trade this week would be earnings trades if we have anything of significance. So we can take a look at that. And so this week we got not a huge number, 30 reporting. Nike in the Dow, Micron, Cintas, and Paychex. So really the only one that might be of significance here is MU, Micron. Nike will be significant, and then all those companies are in the S&P 500 anyway, so we could have just looked at S&P 500. So Nike, Micron, FedEx will be significant. The other may be General Mills, and the others we can kind of ignore. CarMax or Carnival Cruise Lines. Those aren't going to be hugely significant in terms of impacting the index. But Nike for sure, Micron, and maybe General Mills just because it's a consumer staples. And we saw earlier this morning that consumer staples was one of the weakest sectors. And if we see weakness in General Mills, that could send this consumer staples sector even lower. So we'll want to watch out for those. But with the low volatility that we have and the downward pressure, the how elevated we are in the markets, the likely direction of any reaction to any earnings report is actually more likely to the downside than to the upside, unless the reports are just amazing and the forward-looking statements are just amazing. So I don't think that's going to be the case. If we look at Nike has been trading up, but in terms of retail buyers, the ability for the consumer to keep on consuming, they might get a boost from Christmas, but you wouldn't know that until the next quarter. So we're just kind of the potential for earnings surprise is to the upside, that in a way that causes people to be super enthusiastic about these stocks is a little bit lower than normal. So we can play these earnings trades to the downside a little bit more safely than we normally can. So these earnings trades could be they are a little bit higher probability than they normally are if we play them to the downside. So that could be a good option for trades this week if we're struggling to find some opportunities because of how choppy everything is. So that's about it. We just want to be hyper aware that we are in a thin market. There's not nearly as many participants as normal, and that we are at these kind of bleeding levels, like it hurts your eyeballs to see how much it's gone up. And then anyone who has tried to front run this and say, oh, well, this is the top, or this is the top, or this is the top, they're just getting hammered over and over and over again. Eventually they'll be right, but who knows if their portfolio survives by that time. So we just have to be very careful in our portfolio allocations and in the opportunities that we pick to actually allocate our money to. And this close to the end of the year, most portfolio managers are going to be playing it more conservatively unless they are significantly underperforming the S&P 500. And those guys are going to be swinging for the fences and trying to hit home runs, trying to just make these outsized gains to catch up. But because if I'm 10% behind the S&P 500, and I can go, if I make a series of trades and I can be 5% below the S&P 500, that is a good prospect for me if I risk going down to 15% under. So 10% is already so far behind the S&P 500 that if I go 15% behind, I'm in the same boat. I'm going to have the same conversation with my investors. I'm going to have the same conversation with my bosses, my managing directors, my whoever is overlooking my performance. I'm that conversation at 10% underperforming versus 15% underperforming. It's the same conversation. I'm in the same hot water. But if I can go up 5% and say, hey, I'm only 5% under, then it becomes a different conversation. So the ones who are significantly underperforming the S&P 500, they're going to be willing to risk at this point and try to hit the home runs, because if they miss, they're in the same boat anyways. But if they make it, then they're in a much better position. So otherwise, if you're a portfolio manager and you're keeping up with the S&P 500 or you are outperforming the S&P 500, you just be sitting on your hands and just riding out the rest of the year, because you wouldn't want to risk your performance numbers. You wouldn't want to risk your bonus that you would be getting because of your performance. So that is another reason, other than simply people being on holiday and on vacation. That is another reason why we get deflated participation towards the end of the year. Okay? So just be careful in your allocations. And I'm going to recommend once again, since today did play out basically exactly how we thought, it might be a good time period for you to just sit out, just watch the markets just for fun. If you want to review your performance over the past year, enjoy your time with your family, or pursue a little bit more education if you feel like that's what you need to help you perform well in the next year. Okay? So that's it for today. I will see you guys tomorrow in the pre-market session.